Have you ever felt that subtle hum of financial anxiety? Maybe you're navigating a new place, like say the United States, and suddenly all the money rules you thought you knew feel, well, different.
Yeah.
It's not just the jargon, right? It's that feeling you're missing some critical piece of the puzzle.
Definitely.
Well, today we're doing a deep dive into personal finance, specifically in the American market. Our mission really is to take a comprehensive guide, kind of distill its core wisdom, and give you a shortcut to understanding how money truly works here.
Right.
We want to blend those universal financial truths with the often surprising, unique characteristics of the U.S. system.
And it's really striking how even fundamental principles, things that seem universal, play out so differently depending on, local regulations, market structures, even cultural stuff.
Exactly.
So this deep dive will really uncover those critical distinctions. It's about helping you understand not just the what, but the specific how and why within this American financial context.
Okay, let's unpack this then. And we'll start somewhere maybe a bit surprising, because it's not just about the numbers initially. It's really fundamentally about your relationship with money. The guide we're looking at highlights this concept. They call it the I'm okay, money's okay philosophy.
I do like that.
It sounds simple, maybe deceptively so, but it's foundational. It means recognizing your own ability to manage finances. That's the I'm okay part.
Mm-hmm.
And seeing money as just a neutral tool. Not good, not evil, not something to worship or fear. That's the money's okay side.
And the key insight there, I think, is how crucial that mindset is. Because it promotes, proactive, rational decisions. It encourages learning, even when you mess up.
Yeah, learning from mistakes is huge.
It is. It's about realizing that financial well-being isn't purely analytical. There's a deep psychological basis. It helps you avoid those emotional reactions, like panicking when the market dips.
Which is easy to do. Oh, absolutely, especially if you're new to the U.S. system. This mindset can honestly be the difference between feeling totally overwhelmed and feeling empowered.
That okay, money's okay philosophy, it sounds straightforward. But when you're facing a complex system like the U.S., what's the biggest mental block people hit? That cultural hurdle, maybe?
That's a great question. I think often it's just the sheer complexity. The number of choices can be paralyzing.
Right.
People might feel they can't be okay if they don't understand every single investment or tax rule, which is impossible at first.
Yeah.
The insight is that I'm okay means accepting you'll learn as you go.
Yeah.
And money's okay means seeing it as a tool you control, not some beast controlling you, even with all the details.
Okay, that makes sense. So, mindset tune. First practical step, budgeting, expense management.
Yep, gotta know where it's going.
Getting real with your spending. Our guide really zeroes in on what it calls expense drift. Those little, almost invisible things, subscriptions, fees unique to the U.S. market maybe that just silently drain your budget.
Oh yeah, the silent killers. Totally. The insight isn't just tracking. It's like relentlessly hunting down these invisible leaks. We've all been there, right?
Mm-hmm.
That gym membership you forgot about or some app subscription you used once.
Yep.
The guide reminds us these small leaks can genuinely sink a big financial ship.
And the U.S. has some really popular structured ways to tackle this. The 50-20-30 rule is huge here.
Explain that one.
Simple concept. 50% of your take-home pay for needs rent, groceries, utilities. 20% goes to savings or debt payoff. And the last 30% is for wants, dining out, hobbies, entertainment.
Okay, that's clear. Needs, savings, wants, simple framework.
Very effective for setting boundaries.
I like that. Another one is pay yourself first. That's more behavioral, right?
Exactly. You treat savings like your most important bill. First thing that comes out of your paycheck, ideally automated.
So it just happens, takes the willpower out of it?
Pretty much.
Yeah.
Overcomes procrastination.
But what if things are really tight? Someone's just starting out, maybe life throws a curveball. Can you always pay yourself first?
That's a fair point. The nuance is it might start small, like really small. Maybe just $50 or even $20 a month.
Okay.
The habit is more important initially than the amount. You're building that savings muscle.
Got it. Build the muscle. What else?
There's zero-based budgeting. This one's intense.
Oh, so.
You assign every single dollar of income a job. Needs, wants, savings, debt. Everything gets allocated until your income minus expenses equals zero.
Leaves no room for impulse buys, I guess.
Precisely. Very deliberate. And then there's the classic envelope method.
Like actual envelopes with cash?
Can be.
Yeah.
Or digital versions using apps. You allocate specific cash amounts for categories like groceries or entertainment. When the envelope's empty, spending stops.
Old school but effective. So lots of tools, really.
Yeah, concrete, habit-forming approaches that work well within the American system.
But, okay, what if cutting costs isn't enough? What if the real issue is just
Uh,
not enough income?
yes, the other side of the equation,
Our guide really pushes us to think beyond just saving, to earning more. And it talks about investing in yourself.
which is crucial.
It's not just fluff, right? In the US job market, things like getting new skills, staying healthy, even learning another language, these can directly boost your earning potential.
Absolutely. It's about building your human capital, your own skills, your health, your knowledge. In a competitive economy like the U.S., proactively developing these is arguably just as vital as managing investments.
So it's foundational, really. Increases resilience, opens doors that just cutting costs can't.
Exactly. It's a game changer for long-term stability.
Okay, so mindset's adjusted. You're tracking the dollars, maybe working on earning more. What's the next absolute must-have to, sleep better at night financially?
That's safety net. You need a buffer.
Right. And in the U.S. context, that cornerstone is the emergency fund.
Couldn't agree more. It's not just basic savings. Here, it's a critical buffer against things like sudden job loss or those unexpected, often high healthcare costs, things that can derail years of planning otherwise.
So how big should this fund be? What's the recommendation?
The standard advice is 3 to 6 months of essential living expenses. Though, honestly, many experts now lean towards at least 6 months just for extra security.
6 months of expenses, okay. And crucially, where do you keep this money? Not just in your checking account.
Correctly not. It needs
Yeah.
to be separate. Accessible, but not too accessible, so you aren't tempted to dip into it for non-emergencies.
Makes sense. So where?
Our sources really emphasize federally insured products. High-yield savings accounts are great. Maybe certificates of deposit CDs.
Why those?
Safety and liquidity, mostly. They minimize market risk. With CDs, though, there's a small catch, potential penalties if you withdraw early. So maybe not for money you might need tomorrow.
Okay, so savings accounts are probably the go-to for most of the fund. How do you build it up? Feels daunting.
Little by little. Automatic transfers from each paycheck are key. Even small amounts add up.
Like the pay yourself first idea again?
Exactly.
Okay.
Or dedicate windfalls, tax refunds, bonuses straight into the fund until it's full.
The key insight here seems to be the U.S. system's strong focus on federally insured products, like FDIC insurance.
Yes. That points to a specific market mechanism for safety. It's not just a general idea of keep savings safe. It's a structured protection baked into the system.
Let's dive into that then. FDIC insurance. Federal Deposit Insurance Corporation. Sounds important.
It is. It's fundamental to trust in the U.S. banking system. Basically, it protects your deposits if an FDIC-insured bank fails.
That's to a certain limit, right?
Right. The standard limit is $250,000.
Yeah.
But here's the strategic part. It's per depositor, per insured bank, per ownership category.
To ownership category, what does that mean?
It means how the account is titled. Like, an individual account is one category, a joint account with your spouse is another, a trust account is another.
So you could potentially get more than $250,000 insured at one bank.
Exactly. A couple could easily insure, say, $1 million at one bank by using individual accounts and a joint account. Or you can spread money across multiple FDIC-insured banks.
That's a level of detail and strategy maybe not found everywhere. It's a tool, not just a safety net.
Precisely. It covers checking accounts, savings accounts, CDs, money market deposit accounts, your basic deposit accounts.
Good to know. So going back to those saving habits we talked about, 5-20-30, pay yourself first. They're not just for building wealth. They're also kind of your first defense against getting into bad debt, right?
Absolutely. They build the discipline.
Yeah.
These principles find really concrete applications here, specific ways to build financial discipline.
Which is a perfect lead-in to our next topic.
Yeah.
Sailing into potentially choppy waters.
Yeah.
Debt. The American landscape of debt.
Always a big topic.
It's often misunderstood, I think. Our
Yeah.
guide helps clarify things. It's not just debt is bad. In the U.S., there's this really crucial distinction made between good debt and bad debt.
Yeah, and the fascinating insight is how the U.S. system often views debt strategically. Not inherently negative, but as a tool. Its value depends on the purpose and, crucially, if you can manage it.
Okay, so define good debt in this context.
Generally, it's borrowing that helps you acquire an appreciating asset or increase your earning potential. Think mortgages for a home, student loans for education, maybe a loan to start a business.
Things seen as investments.
Right. Investments in your future financial growth.
And bad debt.
Typically, debt for depreciating assets, things that lose value. Cars are a classic example, furniture, luxury goods, or, critically, any debt with sky-high interest rates.
Yeah.
Payday loans, high-interest credit cards.
So most consumer loans, credit cards often fall into bad.
Often, yeah.
Yeah.
Especially if taken thoughtlessly, without a plan, they can create unnecessary financial strain.
But you need to be careful, right? Even good debt can go bad.
Oh, absolutely. If it's unmanageable, if you take on too much, that's where things like your debt-to-income ratio, DTI, come in. Lenders use these ratios to see how much debt you're carrying relative to your income or assets.
So it's a strategic framework, not just a moral judgment. How are you using capital?
Exactly.
Okay, let's apply this to homeownership then. Mortgages. The U.S. market seems incredibly diverse here.
It is. Lots of options. The two main types you'll hear about are fixed rate and adjustable rate mortgages, or ARMs.
Fixed rate seems straightforward. Your interest rate stays the same for the life of the loan.
Correct. Predictable monthly payments, which is great for budgeting, peace of mind. The trade-off is the initial rate is usually a bit higher than an ARM.
Then ARM's adjustable.
Right. They start with a lower interest rate for an initial period, maybe 3, 5, 7 years. After that, the rate adjusts based on market conditions, so your payment could go up or down.
So potentially lower payments at first, but more risk later.
Exactly. Might be good if you plan to sell or refinance before the rate adjusts, but you need to understand the risk of rising payments.
And when it comes to paying it off, shorter loan versus longer loan.
There's a trade-off. Mathematically, a shorter term, like 15 years instead of 30, means you pay way less interest overall.
But higher monthly payments.
Right. A longer term, like 30 years, gives you lower monthly payments. That provides flexibility, maybe some psychological comfort, especially if cash flow is tight or uncertain.
So it's balancing the pure math optimization against personal comfort and flexibility.
It really is. And beyond fixed and adjustable, you have conventional loans, jumbo loans for expensive properties, government-backed loans like FHA or VA. Lots of choices.
Requires some homework then.
Definitely. More choice means more need to understand what fits your situation.
Okay, now let's tackle the bad debts. Consumer stuff, credit cards, auto loans. How does managing these impact you here?
Hugely. Mismanaging high-interest debt tanks your credit score.
And that matters because...
A lower credit score makes everything more expensive or harder to get. Future loans, mortgages, car loans, even renting an apartment or getting decent insurance rates, it ripples through your whole financial life.
Wow. Okay, so how do you get out from under it efficiently?
Two popular strategies. One is debt consolidation.
How does that work?
You basically take out one new, larger loan, ideally with a lower interest rate, to pay off multiple, smaller, high-interest debts like several credit card balances.
Simplifies payments, maybe saves on interest.
Exactly.
Yeah.
One payment, often lower interest, clear schedule.
Okay, what's the other one?
The snowball method.
Sounds fun.
It's more psychological. You list your debts smallest to largest, regardless of interest rate. You make minimum payments on all but the smallest and throw every extra dollar at that smallest one until it's gone.
Then you take the money you were paying on that smallest debt.
And add it to the payment for the next smallest debt. Creates momentum. Knocking out debts quickly feels good, builds motivation.
Even if it's not strictly the cheapest way in terms of interest paid.
Correct. Sometimes the psychological win is more powerful for sticking with the plan. Either way, you need a clear strategy.
And auto loans. You mentioned cars often being bad debt.
Yeah, because they depreciate. It's crucial to do a real cost-benefit analysis. Don't just look at the monthly payment. Factor in the down payment, insurance, gas, parking, maintenance.
And compare that to alternatives like ride sharing or public transport.
Right. See if owning that car on credit truly makes financial sense for you. These strategies aren't just about paying bills. They're about managing the stress and protecting your creditworthiness, which is vital here.
Okay, powerful stuff. Let's shift gears now. Moving from managing debt to building long-term wealth, investment strategies in the U.S.
All right, the growth engine.
The absolute core principle, universally, is risk equals return, right? Higher potential return means higher risk.
Always. No free lunch in investing.
But the insight for the U.S. market seems to be the sheer granularity of control you have over that risk.
That's a great way to put it. The spectrum is incredibly wide, from ultra-safe U.S. treasuries all the way to speculative tech stocks or crypto. You can really dial in the exact risk level that matches your goals and tolerance.
A level of choice maybe not found everywhere.
Potentially, yeah. And diversification is the other bedrock component.
Don't put all your eggs in one basket.
Exactly. Spread investments across different asset classes, stocks, bonds, maybe some real estate, gold, different currencies. and it smooths out the ride.
And why invest at all? Why not just save cash?
Inflation. Cash loses purchasing power over time. Investing is necessary to outpace inflation and achieve real growth for long-term goals like retirement.
And for beginners, it can feel intimidating.
Start small. Seriously. Buy one share of an inexpensive ETF or stock. Get your feet wet, learn how it feels, how the platform works, before committing big money.
Okay, so what's in the U.S. Investors Toolkit? Let's start with stocks.
Stocks or equities. You're buying ownership in a company. Potential for capital growth if the company does well, maybe dividends. But they carry risk, the value can go down too.
And the U.S. market is huge. Tech giants, small caps.
Massive variety, which offers opportunity but also means doing your homework on specific companies or sectors.
Okay, what about bonds? Generally seen as safer.
Generally, yes. You're essentially lending money to an entity, the government, or a corporation. They promise to pay you back with interest.
You mentioned U.S. Treasuries. What makes them special here?
They're backed by the full faith and credit of the U.S. government, so considered very low risk. Plus, some types offer unique features. TIPS, for example, protect against inflation.
TIPS.
Treasury inflation-protected securities. Their principal value adjusts with inflation. And Treasury interest is usually exempt from state and local income tax.
Ah, tax advantages. What other bonds?
Corporate bonds, issued by companies. Higher potential return than Treasuries, but also higher risk depending on the company's financial health. And fully taxable.
And municipal bonds, or munis.
Issued by state and local governments for public projects. The big draw is the interest is often exempt from federal income tax.
Tax-free income. Nice.
And sometimes state and local tax too if you live where it's issued. But they do carry some default risk, though it's generally low.
Okay, stocks, bonds. What about alternatives? Like gold?
Gold's the traditional safe haven, right? People flock to it in crises. But holding physical gold can be cumbersome, storage, insurance, selling it.
So how do most U.S. investors get exposure?
Increasingly, through gold ETFs. Exchange-traded funds that track the price of gold. You buy and sell them, like stocks. Much easier, more liquid.
Treats gold more like a financial asset.
Exactly. Another big alternative is real estate.
Owning property directly?
Rentals. That's one way.
Yeah.
But it requires significant capital, management effort, and it's illiquid.
The alternative.
REITs, real estate investment trusts.
How do those work?
They're companies that own or finance income-producing real estate office buildings, shopping malls, apartments. You buy shares of the REIT on the stock exchange.
So you get exposure to real estate without buying a building.
Precisely. Benefits include liquidity, you can sell shares easily, diversification across many properties, and often high dividends.
Why high dividends?
They're legally required to pay out most of their taxable income, usually 90% to shareholders. Can be a good income source and inflation hedge.
Okay, lots of individual options. But what about diversification? Buying all these things separately seems hard.
That's where ETFs and mutual funds come in. They're like pre-packaged baskets of securities.
So you buy one thing, but get exposure to many underlying investments.
Exactly. Diversification made easy. They can hold hundreds or thousands of stocks or bonds, tracking a market index or a specific sector.
What's the main difference between ETFs and mutual funds?
A few key things. ETFs trade like stocks throughout the day. They're often passively managed, just tracking an index, which usually means lower fees, and they tend to be more tax efficient.
And mutual funds?
They're priced just once a day after the market closes based on their net asset value, or NAV. Many are actively managed, meaning a manager tries to beat the market index. This often means higher fees.
So ETFs may be for lower cost, tax efficiency intraday trading, mutual funds maybe if you want active management, or for simple automated long-term investing.
That's a good general summary.
Yeah.
Both are hugely popular tools in the U.S. for building a diversified portfolio.
Now, something you touched on earlier, taxes. It seems incredibly important for investing here. Let's talk tax-advantaged investment accounts.
Absolutely crucial for long-term planning in the U.S. The idea of tax diversification is key.
Tax diversification, meaning?
Building a portfolio using accounts with different tax treatments. Some are taxed now, like Roth. Some are taxed later, like traditional 401k IRA. Some might have tax-free growth. This gives you flexibility down the road, especially in retirement.
Okay, let's break down the main types. Employer plans first. 401ks.
Right. Or 403bs for nonprofits, public sector. Usually, you contribute pre-tax money directly from your paycheck.
Reduces your taxable income now.
Yes. The money grows tax-deferred. No taxes on dividends or capital gains year to year. Then, withdrawals in retirement are taxed as ordinary income.
Many employers offer a match too, right?
Often, yes. Free money, basically. Crucial to take advantage of that if you can.
What about individual accounts? Traditional IRA.
Similar concept to the traditional 401k. Contributions might be tax deductible, growth is tax deferred, withdrawals in retirement are taxed, available to almost anyone with earned income, subject to income limits for deductibility if you also have a workplace plan.
Okay, then there's the Roth version. Roth IRA, Roth 401k. How are they different?
Roth is kind of the mirror image. You contribute after tax money. So, no tax break now.
But the payoff comes later.
Exactly. The money grows completely tax-free, and qualified withdrawals in retirement are also completely tax-free.
Wow, tax-free income in retirement sounds good.
It can be very powerful. Plus, a nice bonus for Roth IRAs. No required minimum distributions or RMDs during your lifetime. You don't have to take money out if you don't need it.
So you choose tax break now, traditional, or tax break later, Roth.
That's the fundamental trade-off. Depends on whether you think you'll be in a higher or lower tax bracket in retirement compared to now.
Okay. Any other special accounts?
Yes. The Health Savings Account, or HSA. If you have a high-deductible health plan, you might be eligible.
And it's special because
The triple tax advantage. Contributions are pre-tax or deductible. The money grows tax-free. And withdrawals are tax-free if used for qualified medical expenses.
triple tax-free. That sounds amazing.
It is. And if you don't use it for medical expenses after age 65, you can withdraw money for any reason, and it's just taxed like a traditional IRA 401k. So it can double as a powerful retirement savings vehicle.
Interesting. And one more. 529 plans.
Right. These are for education savings college, usually. Contributions aren't federally deductible, but the money grows tax-free. And withdrawals are tax-free if used for qualified education expenses. State tax benefits vary.
So the U.S. really uses the tax code to incentivize specific savings goals, retirement, health, education.
Heavily. Understanding these accounts and tax rules is just as important as picking the right investments for long-term planning here. It gives you strategic control over your lifetime tax burden.
Okay, one last area. Currency diversification. Seems odd maybe for U.S. investors with the dollar being the world reserve currency. Is it still relevant?
It's a fair question.
Yeah.
While not as urgent maybe as in countries with unstable currencies, yes, there's still a case for it even here.
Yeah.
Primarily as a hedge against long-term devaluation of the dollar, even if gradual, and against domestic inflation eroding purchasing power. Think of it as risk management.
So not predicting a dollar collapse, but just managing risk.
Exactly. The dollar could weaken due to things like trade deficits or shifts in global capital flows. Diversification offers some protection.
How do U.S. investors practically do this? Foreign bank accounts.
That's one way. Others include investing in foreign real estate, owning businesses that earn revenue in other currencies, holding precious metals.
Or are there easier ways, like ETFs again?
Yes, foreign currency ETFs are a convenient way. You can buy an ETF that tracks the euro or the yen or a basket of currencies right in your regular brokerage account.
So it's about balance, adding another layer of diversification, acting like insurance for your money.
That's a good way to think about it. Not abandoning the dollar, but prudently reducing overall portfolio risk.
Wow, okay. We've covered a lot of ground, from mindset to budgeting, debt, investing, taxes, even currency.
It's a comprehensive picture. So I guess the big takeaway is managing personal finance here in the American market. It really requires this blend. Universal principles, yes, but combined with a deep dive into the specific U.S. tools, rules, and even the psychology.
Yeah, cultivating that healthy attitude, using the specific mechanisms available, and just committing to keep learning.
Exactly. It's an ongoing process.
So a final thought to leave our listeners with. Given this incredible array of financial tools and tax incentives we've discussed specific to the U.S., how might really understanding these nuances not just, save you money, but actually actively shape your big life goals, education, homeownership, retirement, maybe in ways you haven't even considered yet?